Hello there. I hope all is well. Welcome to this new topical lecture on balanced price ranges. Balanced price ranges are, in my opinion, one of the most important things to understand about price delivery. The moment I understood balanced price ranges, my trading was taken to a whole new level, and therefore I am sure that after watching this lecture, you have experienced many different light bulb moments on why price did what it did. So, without talking too much, let's dive straight into today's exclusive lecture. Let's take a look at the table of contents for this lecture. We're going to first of all take a look at delivery states. Secondly, we're going to take a look at what an imbalance is. Thirdly, we will take a look at the question, how does an imbalance get rebalanced? We will then take a look at what makes a price range balanced. And we will then take a look at delivery profiles. And finally, we will be taking a look at chart examples. So let's take a look at the two states of delivery first of all. Every single market move is either bullish or it's bearish. Even within a consolidation where the market is going sideways, we see up and down fluctuations. When we are bullish, we call this buy side delivery. In order to understand what bullish is, you need to understand that bullish order flow is when we're making higher highs and higher lows, and bearish order flow is called sell side delivery. This is the opposite. This is when we're delivering lower lows and lower highs. Before we dive deeper into this lecture, I'm first going to mention that if you do not understand the foundational topics that I have discussed within my mentorship yet, meaning if you do not understand MMXM clearly yet or liquidity yet, I would highly suggest you and highly advise you to first go and study previous educational content, because this lecture is going to be advanced, and this lecture is going to be probably too advanced if you do not have a clear understanding of MMXM just yet. But don't worry, one day you will have that clear understanding of MMXM, market maker models, and then you'll be able to watch this lecture and the light bulb moments will just occur after one another. This does not mean you shouldn't watch this lecture right away. You can, however, don't be upset if you don't understand a lot of it just yet. I feel like it's important to throw this out there in advance before I dive into today's lecture, because else I can already anticipate some of you to be upset by the fact that you did not understand the majority of things that will be discussed. What is an imbalance? An imbalance is a lack of balance between the amount of times sell side or buy side was delivered within a price range. This makes the price range inefficient. The reason why it's very important to know when a price range is inefficient is due to the following. Markets need to be delivered in an efficient manner if they're algorithmically driven. If the price range is not efficient yet, the market is not allowed to expand towards the next price range. That right there is a key note. Hence the terms BC, buy side imbalance, sell side inefficiency, and CB, sell side imbalance, buy side inefficiency. In order to visually represent an imbalanced price range, I'm going to make use of the following image. I want you to see how this seesaw right here contains two balls. A big ball right here and a small ball. What you need to understand is that the small ball is heavier than the big ball, and therefore the small ball is, of course, lower, whilst the big ball is being sent into the sky. What I will do is the following. I will annotate to these balls two different words: buy side and sell side, the two different delivery states. And some of you are already experiencing a light bulb moment right here. And the reason why I know that that is the case is because when I began looking at the markets through this perspective, and I began looking at them from an imbalanced or balanced price range perspective, for me, all of the sudden, it made sense why certain retracements, for example, did not occur and why the market just began on expanding into one-sided directions, or why the market did retrace and then began to expand, because it all has to do with the falling image. And I know it might seem a bit childish what I'm about to do with you, but trust me, give me some time and I promise that you will never be able to look at the markets from the same perspective again, because it's a eye opener. It's a paradigm that I'm teaching you. Here you can see that sell side was delivered twice right here on this side, and that buy side was only delivered once. Therefore, the sell side is right now heavier, and there's an imbalance between the weight of these two delivery states. Because this is the case, this price range is imbalanced, and that's what you need to view this like. You need to envision that right now this is simply a price range that we're trading in, and we're showcasing how many times both sell side and buy side have been delivered. Sell side twice, buy side once. For the opposing side, it would look like the following, where we would have buy side twice right here and sell side once. Some of you are probably already thinking, okay, well, what scenarios are being followed? This right here is when we're seeing a bullish scenario taking place, and this right here is when a bearish scenario is taking place. That probably went too quick for you, but don't worry. I will show you some schematics and that it will be easier to understand. What I want you to note is that we're paying attention to the amount of times both sell side as buy side have been delivered inside of that specific price range. That is what counts. Counting the amount of times certain delivery has taken place. How does an imbalance get rebalanced? An imbalance gets rebalanced when the side of delivery that caused the inefficiency to take place gets delivered again inside of the price range. To you, this might seem a bit hard to understand right now because I have only explained logic to you. But you need to understand that in your mind, the logic needs to make sense. And it's possible that the logic will click once we begin to take a look at the visuals. So don't worry if it's not clear to you yet what I'm explaining. But I'm trying to make you think about the exact sentences that I'm writing down, because these sentences need to click in your mind. And once they click in your mind, it's a wonderful experience because you all of a sudden can make sense behind why these events occur over and over again. So what makes a price range balanced, you might be wondering? A price range becomes balanced once both sides of delivery have been delivered an equal amount of times inside of the price range. Let me repeat that. A price range becomes balanced once both sides of delivery have been delivered an equal amount of times inside of the range. When this is the case, price has been delivered efficiently inside of the price range. I don't care how many times you need to re-listen to that in order for it to click, but do it if it's not clear to you yet. Because this sentence right here is literally how the market moves. It's all about balancing out imbalanced price ranges and drawing towards equity. That's it. First of all, we see sell side lower, creating this CB. We then deliver buy side into that CB's price range. This buy side delivery gets followed by sell side delivery lower. We have now seen sell side delivery twice and buy side delivery only once. We then see buy side delivery higher, and inside of this buy side delivery, we can see the creation of an BC, meaning there was a lack of sell side delivery inside of this buy side delivery. So you have seen buy side twice and sell side twice now. The sell side inside of this move and the sell side inside of this move. The buy side inside of this move and the buy side inside of this move. But like I already mentioned, a BC got created inside of this second leg higher. And because that occurred, we need to see sell side delivery once more into this old high, into this old BC, and then we're allowed to expand. And that right there might be a bit confusing because you would think, well, we have seen sell side 3 times then, right? And buy side only twice. Think about it through the following perspective. You need to understand that this move higher right here lacks something. What does it lack? It lacks a retracement which offers sell side to balance the delivery higher. And therefore the retracement has to take place before the market is allowed to expand. And this right there is crucial to understanding market reversals. Because you need to understand that within a market maker buy model, this is the smart money reversal right here. So a balanced price range is crucial in order to understand when the market is likely going to reverse next. If we would take a look at the opposing scenario, where we would see lower prices, it would look like the following. Where we would see buy side delivery, this buy side delivery creates some BC, the market retraces into that BC, forming a low. The market then trades away from this low, offering buy side again. So we have seen buy side twice now and sell side once. We then see sell side delivery lower, trading below this low with a CB. So we need to see buy side delivery back into this low once more in order to balance out this price range from this low to this high. And then we're allowed to expand. Then we're allowed to trade away. So again, keep in mind that if you would count, you would get to the following. You would see buy side once, sell side, buy side. So now it's 2 buy side, 1 sell side again. So now it's 2 buy side, 2 sell side. But because this sell side delivery leaves an imbalance, we need to offer buy side once more and then expand lower. Because this CB has to get repriced into, and the moment we trade away from it, right here, we rebalanced that area. So the imbalance gets rebalanced the moment that we trade away from it, and that's very important to understand. The retracement into an imbalanced price range is repricing, but the move away from the imbalanced price range is the rebalancing aspect. If we would take a look at a scenario in which no imbalance formed on the left side of the curve, it would look like the following. Where we would see sell side delivery, buy side delivery, sell side delivery. So now we have seen sell side twice and buy side only once, followed by buy side delivery, but this buy side delivery creates this BC. Therefore, we need to see sell side delivery into that BC once more before we're allowed to expand higher. This repricing lower is the move that we can enter based upon if we would decide to do so. Notice as this lines up with this high. So the moment we reprice lower into this high, into this BC, it means that this price range from this high to this low has been balanced and that we're allowed to expand away from it. For the opposing side, it would look like the following, where we saw buy side delivery, followed by sell side delivery, followed by a new leg higher, meaning buy side delivery took place. So we have seen twice buy side delivery now and sell side delivery only once. We then see sell side delivery again, creating a CB, displacing through this low. So we need to reprice higher, offer buy side, and then allow it to expand towards the downside. I can understand that this might be a bit confusing for you, but when we take a look at more examples of this, it will become clear. Another example looks like the following, where we would see buy side delivery, followed by sell side delivery, followed by new buy side delivery. So we have seen buy side delivery twice inside of the price range from this high to this low. So something's lacking. What's lacking? Sell side delivery, because we only saw that once inside of this leg lower. Therefore, we need to offer sell side once more before we're allowed to expand. This repricing lower offers that sell side, and the moment we trade away from it, it's the rebalancing aspect. For the opposing side, for the bearish scenario, it will look like the following, where we would see sell side delivery lower, followed by buy side delivery, followed by a new leg lower sell side delivery. So at this moment, we have seen sell side delivery twice inside of the price range from this low to this high. So we need to offer buy side once more before we're allowed to expand lower. And this move higher is repricing, and the moment that we trade away from this low, this price range becomes balanced. Now, notice that I have annotated simply this high, this low, and this high, and this low. These lines can be drawn all the way into the infinite, meaning you can extend these lines all the way to the left and right, and that's when you establish the price range, because you need to understand that this low formed at a specific price and this high formed at a specific price, and it's about the balancing of both buy side and sell side delivery inside of the range between this low and this high, its respective price. Think about how I'm teaching you to look at very specific price levels. Light bulb. Let's take a look at some chart examples. What I will do is I will take you through the potential scenarios of a balanced price range taking place. I've been discussing the topic of institutional order flow entry drill with you as well lately, and you need to understand that institutional order flow entry drill only occurs when there's a balanced price range that is taking place. A little gem for those of you that are still paying attention and that are still able to listen properly. Okay, so what I want you to see is the following. I want you to see how we're delivering lower right here, as you can see, and eventually we see this formation of a bullish formation of a low, where we see sell side delivery taking place, a short-term low forms right here, market retraces after delivering lower, so we see sell side, buy side, sell side taking out this low, and we then see buy side delivery higher, but inside of that buy side delivery, we see the creation of a BC. So the market was inefficiently delivered on the sell side. There was a lack of sell side delivery inside of this move, and therefore we need to see sell side delivery once more before we're allowed to expand higher. The repricing lower is crucial. Notice we just step into this BC. This is IOFET, and we then expand away from it. The moment we expand away from it, the price range from this high to this low becomes balanced, and we're allowed to expand towards the upside, because that is where the real draw liquidity is. Notice that price never revisits the price range of this high to this low. The bearish example would look like the following, where we would see buy side delivery, followed by sell side delivery, followed by buy side delivery, followed by sell side delivery. So we have seen both buy side and sell side twice now, but the sell side delivery itself was not balanced out yet. Why not? Because you need to understand that we traded below this low. And what do you know? A wick is a gap, meaning you need to look at this low as a gap that has to get rebalanced once we trade below it. So what we see is that we deliver below this low, we reprice below it, we then reprice higher. Notice how this candle opens up, forms the high exactly at that respective low, the low of that imbalanced price range. This small wick offers buy side. From the open of this candle to the high, buy side delivery is taking place, but more so to the following. From this low that formed here to this high, buy side delivery took place, and then we're allowed to expand lower, because this is what balances the price range between this low to this high. Notice that the market never revisits that price range again, and then we're allowed to expand. On the 15-second chart on the lower time frames, you can see the following. You can see that a gap, a volume imbalance, displaces through this respective candle's low. What can we then see? This is when true support turns resistance ideas work. The moment that we trade below and displays below a low, a old support level, so to say, we anticipate that low to function as resistance on price. Why? Because we traded through it with a gap. And this is on a lower time frame chart in that same delivery. But I want you to understand that this is what it looks like on a higher time frame chart. It doesn't matter what market we're looking at, it doesn't matter what asset we're looking at, it doesn't matter if we're looking at Bitcoin, or if we're looking at Forex, or if we're looking at gold, or at the index futures, whatever. This works across all markets because this is how price is fractal. Another example would look like the following, where we would see sell side delivery, a CB gets created right here, buy side gets delivered into this CB. We then see sell side delivery again delivering lower, followed by buy side delivery. We trade above this candle's high, and now we need to see whether or not we're going to see a retracement take place. We see a retracement into this BC, offering sell side delivery. This is repricing lower, followed by an expansion higher. The moment that we leave this price range that has just been established, this price range has been balanced, and we anticipate the market to expand away from it. The price range that has been balanced is the following from this high to this low, where we saw both sell side as buy side get delivered in an equal amount of times. However, because this move higher was imbalanced itself, because there was a lack of sell side delivery, we need to see sell side delivery before we can expand. And that is very important to understand. So the equation itself, when you count the amount of delivery, always adds up to 5. 2 on the sell side, 2 on the buy side, but we need to see whether or not that buy side will get repriced lower into, so that we can then continue higher. And that might be confusing at first, but once you understand that this BC signals that there was a lack of sell side delivery inside of this BC, it makes sense for that final retracement to take place before the expansion can take place. Another example would be the following, where we would see sell side delivery, followed by buy side delivery, followed by sell side delivery. So we have seen sell side delivery twice and buy side delivery once thus far. We see buy side delivery next, trading above this high, trading above the price range of this CB. And now we anticipate the market to find support inside of this candle's high. Notice that we retrace over sell side into this candle's high, and we then begin to see signs of wanting to trade away from it. That balances out the price range. Notice that this lines up with this CB, and this is when an inversion value gap in fact functions as an inversion value gap on price, where it's all about balancing the price range before we're allowed to expand into the anticipated direction. The final chart example that we're going to take a look at is the following, where we can see buy side delivery creating a BC, a retracement into that BC forming a low. This is sell side delivery, followed by buy side delivery, followed by new sell side delivery, trading below this candle's low, displacing through it with a CB. So we now anticipate buy side delivery to be next in order for this price range from this low to this high to get repriced into and to then get rebalanced the moment that we trade away from it. Again, keep in mind that we see buy side, sell side, buy side. So we have seen buy side twice, sell side once, we see sell side again. So now we have seen sell side twice as well. However, this move lower right here, it screams displacement, and the displacement leg has to get repriced into before we can continue lower. With that, this lecture comes to an end. I want you to practice with old market data, counting the amount of times buy side or sell side delivery took place before the market began to reverse aggressively. And I want you to simply put in the required time, because right now it might be confusing what I just explained, and that's okay. If the foundation is not clear to you yet, it's of course logical that this lecture is probably above your current level of understanding, and that's not an issue. You just need to have faith in the fact that one day you'll be able to watch this lecture again, and all of a sudden things will begin to click, and things will begin to click rapidly. And when they click rapidly, it will be light bulb after light bulb after light bulb, and that's what you need to hold on to. For some of you, this first time watching this lecture was already probably a great experience and you experienced many light bulb moments. Congrats! I hope you journaled them down properly, written them down properly. If you did not yet, I would highly advise you to do so. But I truly hope that you will spend the time investigating what is shared during this lecture, because this is how I internalize market reversals and market retracements followed by expansions. Balanced price ranges are, in my opinion, one of the most important things to understand when it comes to looking at the markets from an algorithmic price delivery perspective. I wish you all the best, and I look forward to speaking to you in the next lecture. Be safe.